There's a number floating around right now that most XRP holders have already seen, shared, and gotten excited about. $5,000, $9,000. Numbers so big they almost stop sounding real, which is exactly the problem. Because when a number stops sounding real, people stop questioning it. They just believe it. And I want to be honest with you about something before we go any further. I think XRP has a real shot at a historic run in the next few years. I'm not here to talk you out of being bullish, but I've been doing this long enough to know that the gap between this is mathematically possible and this is what's actually going to happen is where most retail investors lose their shirts. So today, I'm not just reading you a price target. I'm going to walk you through the actual mechanics behind it, the assumptions baked into it that nobody talks about. What would genuinely have to happen in the real world for a number like $9,000 to materialize, and where the far more boring, far more likely outcomes sit. Because right now, while you're hearing about five-figure XRP, here's what's actually happening underneath the surface. XRP has spent most of this year stuck in a brutal range, down significantly from where it was trading just months ago. The regulatory bill everyone's been waiting on still hasn't passed the Senate floor. One of XRP's largest institutional ETF holders quietly walked away from its entire position earlier this year, and the broader crypto market is dealing with a macro environment that isn't exactly throwing gasoline on the fire. None of that means the bull case is dead. It means the bull case is more complicated than a headline number, and if you're only hearing the headline, you're missing the part of the story that actually determines whether you make money or lose it. Stick with me because by the end of this video, you're going to understand exactly what has to go right, what could go wrong, and why the difference between $5,000 and $9,000 isn't really about XRP at all. It's about something almost nobody is talking about. Let's get into it. Let's start with where we actually are right now, because I think this is the part everyone skips past on their way to the exciting prediction, and it's the part that matters most. XRP right now is trading in the low $1 range, not $5,000, not $9,000, around $1.10, give or take, depending on the hour you're watching this. And if you zoom out a little, you'll see that earlier this year, XRP was trading north of $2, even pushing toward $2.20 at one point. So we're not talking about a coin that's been steadily climbing towards some inevitable five-figure outcome. We're talking about a coin that's down nearly half from its own 2026 highs, sitting in a tight, frustrating range that's tested the patience of pretty much everyone holding it. I bring this up first because context is everything in this business. When someone hands you a number like $9,000 without showing you the chart of where the asset actually sits today, they're not lying to you exactly, but they're letting you fill in the emotional gap yourself. Your brain hears 9,000, compares it to $1.10, and starts doing math that feels like a slot machine instead of an investment thesis. That's not analysis. That's hope wearing a calculator. So let's actually be analysts about this. What would it take mechanically for XRP to get from where it is now to even the lower end of a number like $5,000? This is where market cap multiplier theory comes in, and it's worth understanding correctly because most people butcher this concept. You'll hear creators say things like, Bitcoin's market cap is this many trillion, so if XRP just captures a fraction of that, the price has to be this. That sounds intuitive, but it skips the actual mechanism. Price isn't determined by market cap targets. Price is determined by what people are willing to pay for each unit of a fixed or growing supply, multiplied by how much capital is actually flowing into that asset relative to how much of it exists to be bought. XRP has a total supply cap of 100 billion tokens, with around 62 billion currently in circulation. That's a structurally different math problem than Bitcoin, which has a hard cap of 21 million. When you have tens of billions of units outstanding, getting to 4 or 5 figures per token isn't just about adoption, it's about an almost unfathomable amount of new capital entering the asset, capital that would have to dwarf what we've seen enter any cryptocurrency in history by orders of magnitude. We're talking about a theoretical market capitalization that would place XRP not just above Bitcoin, not just above the entire current crypto market, but potentially above the market cap of nearly every company and many national economies on Earth combined. That's not a hot take. That's just what the math requires once you run the numbers honestly. Now, does that mean it's impossible? No. And this is where I want to be careful, because there's a difference between saying something is mathematically extreme and saying it's impossible. The honest answer is that nobody, including me, including whoever wrote that report you've probably seen floating around, can tell you with certainty what XRP will be worth in 5 years. What we can do is examine the assumptions that would have to hold true and assess how realistic each one actually is. The bull case rests on a few pillars, and I want to walk through them honestly rather than dismissing them outright, because there is real substance here, even if the price target stretches it. The first pillar is utility. XRP was built from day one to solve a specific problem, which is the slow, expensive, and fragmented nature of cross-border payments. Traditional correspondent banking can take days to settle a transaction and bleed fees along the way. XRP, through Ripple's network, has been positioned for years as a bridge asset that can move value between currencies in seconds rather than days. That's not speculation. Ripple has spent close to a decade building out partnerships, payment corridors, and infrastructure aimed at this exact use case. The real question isn't whether the technology works. It largely does. The real question is whether the volume of global cross-border settlement that actually flows through XRP rather than through competing solutions, stablecoins, or simply upgraded traditional banking rails is enough to justify a valuation in the thousands of dollars per token. That's a much narrower and more uncertain claim than "this coin has utility." The second pillar is regulatory clarity, and here's where things get genuinely interesting, because this part isn't theoretical anymore. Earlier this year, the SEC and CFTC jointly classified XRP as a digital commodity, which resolved years of legal ambiguity that had hung over this asset like a fog. That ruling matters. It removed one of the single biggest overhangs that kept conservative institutional money on the sidelines. But here's the nuance almost nobody brings up. That classification came through regulatory interpretation, not through a permanent act of Congress. It is, in theory, subject to revisiting under a different regulatory posture down the line. That's not a reason to panic. It's a reason to understand that regulatory clarity right now is real progress, not a permanent, unshakable foundation. On top of that, there's the broader piece of legislation everyone in this space has been watching. The bill designed to create a comprehensive market structure framework for digital assets in the United States. As of right now, that bill has cleared a key Senate committee with a bipartisan vote and is sitting on the Senate calendar waiting for a floor vote. It is not law. It needs roughly 7 additional senators to cross party lines to clear the 60-vote threshold required to overcome a filibuster. Then it needs to be reconciled with the House version, then signed into law. Prediction markets tracking the odds of this passing in 2026 have hovered in a range that reflects genuine uncertainty, not a sure thing. So when you hear someone say it isn't if, it's when, I want you to recognize that as an opinion, a reasonable one, but an opinion, not a confirmed outcome. The honest framing is that meaningful regulatory progress has happened, more progress could be coming, but the timeline and final shape of that legislation remains genuinely unresolved. The third pillar is institutional adoption, and this is where I think the most interesting, underreported nuance lives. Spot XRP ETFs launched in the United States back in November of last year, and they have pulled in over $1 billion in cumulative inflows since then, which is a real, measurable sign of institutional interest. That's not nothing. May of this year was actually the strongest month yet for ETF inflows, but dig one layer deeper and the picture gets more textured. A significant portion of those inflows have come from retail capital moving into a wrapper, not necessarily new institutional money discovering XRP for the first time. And earlier this year, one of the largest single institutional holders of XRP ETF shares, a major Wall Street bank, completely exited its position. Analysts who track these filings suggested that position may have represented trading desk activity rather than a long-term directional bet in the first place, which tells you something important about how cautiously you should interpret institutional headlines. Institutions aren't a monolith. Some are accumulating, some are testing the water and walking away. Both things are true at the same time, and a serious analysis has to hold both of those facts without flattening them into a single bullish or bearish headline. Let's talk about the regulatory piece in detail, because I think this is the single most misunderstood part of the entire XRP conversation right now, and getting the timeline wrong is exactly how people end up disappointed even when the underlying story is actually playing out in their favor. Here's where things stand. The bill everyone's been watching cleared the Senate Banking Committee back in mid-May with a 15-9 vote. That's a meaningful bipartisan signal, not a party line rubber stamp, since it picked up a couple of Democratic votes alongside unanimous Republican support. From there, it got formally placed on the Senate legislative calendar in early June, which sounds like progress. And it is, but I want you to understand what that actually means in practice, because the language used by financial media around moments like this tends to get more dramatic than the reality. Calendar placement means the bill is now eligible to be scheduled for a floor vote. It does not mean a floor vote has been scheduled. It does not mean passage is close in a guaranteed sense. It means the bill is sitting in a queue waiting on Senate leadership to actually carve out time for full debate, amendments, and a final vote. And that final vote needs 60 votes to clear a filibuster. Right now, with all Republicans assumed to be on board, that math requires roughly 7 Senate Democrats to cross over. 2 already did at the committee level. Finding 5 more on the floor, where political pressure and visibility are higher, is a different and harder task than finding 2 in a committee room. Why does this matter for your understanding of XRP specifically? Because the price action we've seen this year has already shown us, in real time, how the market reacts to each individual step in this process. When the bill cleared the committee vote in May, XRP rallied. It pushed up through resistance levels it had been struggling with for weeks. That tells you the market is pricing in this legislation as a genuine catalyst, not just a talking point. But here's the part that should give you pause if you're expecting some kind of straight line move to the moon the moment this passes. The rallies tied to legislative progress so far have been sharp, but they've also faded. XRP pushed above $2 earlier in the year on optimism, then gave almost all of it back as the broader market sold off and the legislative process slowed down. That pattern, a sharp move up on a headline followed by a grind back down as reality sets in, is something every experienced trader in this space has seen before, in XRP and in plenty of other assets. Headlines create spikes. Sustained fundamentals create trends. Those are not the same thing, and conflating them is one of the most common mistakes retail investors make. I also want to address something Wall Street and various banking trade groups have been vocal about, because it's relevant to how confident you should be that this legislation sails through cleanly. Some of the largest banking lobbying groups in the country have publicly pushed back on parts of this bill, specifically around how stablecoins are treated and whether crypto products could effectively compete with traditional bank deposits for capital. When you have organized, well-funded opposition from an industry with this much lobbying power, that's not a minor speed bump. That's a real political headwind that could shape the final language of the bill, delay the timeline further, or in a worst-case scenario for bulls, stall momentum entirely if it drags past key legislative windows like the August recess or gets crowded out by other priorities Congress is juggling, things like budget reconciliation and other unrelated legislative fights that eat up floor time. So here's how I'd frame the realistic range of outcomes, and I want to be very clear about which parts of this are fact and which parts are my own interpretation. As a fact, the bill has bipartisan committee support and is procedurally positioned for a floor vote. As a fact, it has not passed the Senate, has not been reconciled with the House version, and has not been signed into law. As my own opinion, based on watching how these legislative fights tend to play out, I think there's a real chance this either passes in a watered-down form that gives the market less certainty than people expect, or it slips past the summer recess and becomes a story for late 2026 or even 2027 rather than the clean mid-year resolution a lot of bulls are hoping for. I could be wrong about that. Prediction markets tracking this have shown odds hovering somewhere in the 50 to 60% range for passage this year, which is genuinely a coin flip with a slight lean toward yes, not the slam dunk some corners of crypto Twitter are presenting it as. Now let's talk about something just as important as the legislation itself, which is what happens even after it passes, because this is where I think the most unrealistic expectations get built. A lot of retail investors seem to believe that the moment this bill gets signed, regulatory uncertainty evaporates overnight and institutional money floods in within days. That is not how financial regulation works in the real world. Even under the most optimistic timeline, where the Senate finds its votes, the House quickly accepts the Senate's version, and the president signs it before the summer is out, you still need the SEC, the CFTC, and the Treasury to actually draft detailed rules implementing the law. That process involves formal rulemaking periods, public comment windows that typically run 30 to 90 days each, revisions based on industry feedback, and final published rules. Realistically, enforceable, fully built-out regulatory frameworks are not expected to exist until sometime in 2027 at the earliest, even in the rosiest scenario. That doesn't mean the passage of the bill itself wouldn't matter for price. Markets are forward-looking, and a clean legislative win could absolutely trigger a significant rally on sentiment and positioning alone, well before the actual rulemaking catches up. But it does mean you need to separate two very different things in your head. There's the psychological and speculative catalyst of the bill passing, which could move price meaningfully and quickly. And there's the actual on-the-ground change in how institutions are legally permitted to custody, trade, and build products around XRP, which is a slower, multi-year process. If your entire investment thesis is built on the idea that one signature on one bill instantly transforms XRP's institutional adoption curve overnight, you're setting yourself up for a timeline mismatch that could leave you frustrated even if you're directionally right about where this is all heading. There's also a piece of this that I think deserves more scrutiny than it gets, which is the question of how durable that commodity classification really is. Remember, the SEC and CFTC jointly determined that XRP qualifies as a digital commodity back in March, which was a landmark moment. It put XRP in the same regulatory bucket as assets like Bitcoin in terms of oversight, shifting primary jurisdiction toward the CFTC rather than leaving it under the kind of securities ambiguity that defined years of legal battles for this token. That ruling is a major part of why institutional products like spot ETFs were able to launch in the first place. But it's worth remembering this came through agency interpretation and enforcement posture rather than codified law. Congress passing the broader market structure bill would effectively cement that classification into statute, making it far harder to unwind under a future administration with a different regulatory philosophy. Without that legislative backstop, you're relying on the continued goodwill and consistent interpretation of regulators whose posture can shift with new leadership. That's not a reason to panic about XRP's legal status today. It's a reason to understand why so much of the bull case really does hinge on Congress, not just on the regulators who got us this far. So if you're trying to time this, here's the honest framework I'd encourage you to use instead of just waiting for a headline that says the bill passed. Watch for Senate leadership actually scheduling a floor vote date, because that's the next concrete milestone that matters more than calendar placement. Watch how many Democrats publicly signal support beyond the two who crossed over at the committee level, because that vote count will tell you whether 60 is realistic or whether this stalls. And watch the tone coming out of the banking lobby, because continued aggressive pushback there is a signal that the final bill could get watered down in ways that reduce its impact, even if it technically passes. Let's talk about institutional money, because this is where I think the gap between narrative and reality is the widest in the entire XRP conversation right now. Every time a new ETF inflow number gets published, you'll see it shared across crypto social media as proof that the smart money is piling in. And on the surface, the numbers are genuinely impressive. Spot XRP ETFs launched in the United States back in November of last year, and since then they've pulled in well over $1 billion in cumulative net inflows. May of this year was the strongest month yet, with inflows accelerating even as Bitcoin and Ethereum products saw outflows during parts of that same stretch. If you only read the headline, it sounds like institutions are rotating hard into XRP while abandoning the bigger names. That's a compelling story. It's just not the complete one. Here's what I want you to understand about how ETF flows actually work, because this is a piece of market structure that gets glossed over constantly. Money flowing into an ETF doesn't automatically mean new capital is entering the asset for the first time. Sometimes it does, but often it represents existing holders moving their exposure from a wallet or an exchange into a regulated product wrapper for reasons related to taxes, custody, compliance, or simply portfolio reporting convenience. That's not a bad thing. It's actually a sign of maturation, since it means more of XRP's float is sitting inside transparent, regulated vehicles rather than scattered across exchanges and self-custody wallets where it's harder to track. But it is not the same thing as saying $1 billion of brand new money just discovered XRP and decided to buy in for the first time. Conflating those two things is one of the most common analytical errors I see in this space, and it's usually not malicious. It's just lazy shorthand that spreads because the bullish version of the story travels faster online. Now let's get into the detail that I think deserves far more attention than it's gotten, which is what happened with one of the largest single institutional holders of XRP ETF shares earlier this year. A major Wall Street bank had built a meaningful position, reportedly worth somewhere in the neighborhood of $150 million, making it the largest known institutional holder in the space at the time. That position got disclosed through standard quarterly filings, and for a while it was treated by a lot of bullish commentators as concrete proof that serious Wall Street money believed in XRP's long-term value. Then, in a more recent quarterly filing, that entire position was gone, fully exited. Now, before you take that as some kind of doom signal, let's apply the same rigor we've been applying to the bullish side of this conversation. Analysts who track institutional 13F filings had actually flagged, even back when the position was first disclosed, that it likely represented trading desk facilitation activity rather than a long-term directional bet. In plain English, that means the bank may have been holding XRP exposure to service client trades, hedge other positions, or facilitate market making, rather than because the bank itself had taken a fundamental view that XRP was undervalued and going to rip higher. If that interpretation is accurate, then the exit isn't really a bearish signal about XRP's future. It's just a market-making desk closing out a position once the client activity around it ran its course. That's a perfectly mundane explanation, and probably the more likely one. But here's why I'm spending this much time on a single filing, and it's not because I think this one bank's decision determines XRP's fate. It's because of what the market's reaction tells us about underlying demand. In the same week that this exit became public knowledge, Spot XRP ETFs as a category posted their largest weekly inflow of the entire year, pulling in over $60 million even as this $150 million position was unwinding. Think about what that actually required mechanically. For ETFs to absorb that exit and still post a record net inflow week, total buying demand across the other participants had to exceed the combined size of the exit, plus the headline inflow number, somewhere north of $200 million in actual buying pressure showing up to soak up both the outgoing position and still push the net number higher. That's a genuinely bullish data point buried inside a headline that a lot of people would have read as purely negative. This is exactly why I keep telling people in this space to look past the headline and into the mechanics. The headline "Major Bank Exits XRP Position" sounds bearish in isolation. The full picture, where that exit gets absorbed without even denting the week's net inflow trend, tells a more nuanced and arguably more bullish story about the depth and resilience of current demand. Let's also talk about who's actually doing the buying, because the composition of that buyer base matters enormously for how sustainable this trend is. Reporting on these ETF flows has consistently shown that a large majority of the capital coming in, somewhere in the neighborhood of 80% or more by some estimates, has been retail driven rather than from large institutional allocators. That's an important nuance because retail capital and institutional capital behave very differently across a market cycle. Retail money tends to be more sentiment driven, chasing price action and headlines, which means it can flow in fast during excitement and flow back out just as fast during fear. Institutional capital, when it does show up in size, tends to be stickier, driven by mandates, allocation models, and longer time horizons that don't whipsaw with every news cycle. So what we're really looking at right now is a market where a meaningful regulated wrapper exists, where retail enthusiasm has been the primary driver of flows so far, and where the kind of large-scale mandate-driven institutional capital that bulls are ultimately counting on to justify dramatically higher prices is still mostly sitting on the sidelines waiting for more clarity. That's not a bearish conclusion. It's actually a fairly logical and patient one. The asset has built real infrastructure. The on-ramps exist. What hasn't happened yet, at least not at scale, is the wave of pension funds, sovereign wealth allocators, and large asset managers treating XRP as a core portfolio, holding the way some are increasingly starting to treat Bitcoin. That wave may come. The infrastructure built so far makes it more possible than it's ever been. But the infrastructure exists, and the wave has arrived, are two very different stages of an adoption curve. And right now, we're clearly still closer to the first than the second. I also want to bring in something Ripple itself has been doing that gets far less attention than ETF flow headlines, but might actually matter more for the long-term thesis. Earlier this year, Ripple completed a pilot involving tokenized US Treasury settlement on the XRP ledger, working alongside major names in traditional finance and payments infrastructure, processing a redemption in under 5 seconds. That's a genuinely interesting proof of concept because it points toward XRP's underlying ledger being used for real-world asset settlement, not just as a speculative trading vehicle. Ripple has also been expanding its prime brokerage offerings, securing debt facilities to support institutional grade margin and financing products built around its platform. These are the kinds of developments that don't move price in a single day, don't trend on social media the way a price prediction headline does, but actually build the underlying plumbing that a genuine institutional adoption wave would eventually run through. If you're trying to separate noise from signal in this space, I'd argue these quieter infrastructure developments deserve more of your attention than the next viral price target, because infrastructure is what eventually makes big price targets possible in the first place, if they're ever going to happen at all. Here's the honest synthesis of everything we've covered on the institutional side. As fact, ETF inflows have been positive and resilient, surviving a meaningful institutional exit without breaking trend. As fact, the majority of that flow appears to be retail rather than large-scale institutional capital. As my own interpretation, I believe the actual large-scale institutional wave, the one capable of justifying the kind of valuations getting thrown around in 5-figure predictions, has not arrived yet, and its timing is tied much more closely to the regulatory outcome we discussed in part 2 than to anything happening in the ETF market today. The infrastructure is being built, the capital hasn't fully shown up to use it yet. That gap between infrastructure and capital is, in my view, the most honest way to describe where XRP actually sits right now. Let's zoom out because I think this is the part of the conversation most XRP-focused content completely ignores, and it's honestly one of the most important pieces of the entire puzzle. XRP does not trade in a vacuum. No altcoin does. And right now, the broader macro and crypto market environment has been working against the bullish thesis in ways that have nothing to do with Ripple, nothing to do with the legislation we talked about, and nothing to do with ETF flows. This year has seen a meaningful, broad-based sell-off across crypto, with Bitcoin trading well below levels it touched earlier in the cycle, dropping under the high $60,000 range during some of the most recent pressure, and the total crypto market shedding billions of dollars in value within single trading sessions. Some of that pressure has been tied to issues entirely outside the crypto world, like weakness in the semiconductor and broader tech sector spilling over into risk assets generally, since crypto has increasingly traded like a high beta extension of tech and growth stocks rather than as some kind of independent, uncorrelated asset class the way it was sometimes pitched years ago. This matters enormously for XRP specifically, and here's why. Altcoins, almost without exception, take their directional cues from Bitcoin first and their own fundamentals second. I know that's not the sexy narrative when you're trying to build a case for an asset based on its own merits, but if you've been around this market for more than one cycle, you already know this pattern intimately. When Bitcoin is healthy and trending up, capital rotates outward into altcoins as risk appetite expands and traders look for higher beta plays. When Bitcoin is under pressure, that risk appetite contracts fast, And altcoins tend to get hit harder on the way down than Bitcoin itself because they're viewed as the more speculative, less liquid end of the risk curve. We've seen exactly this pattern play out with XRP this year. It's down significantly more from its highs than Bitcoin is from its own highs over the same stretch, which is a textbook example of higher beta behavior in a risk-off environment. So when someone hands you a $5,000 or $9,000 price target for XRP without addressing what Bitcoin needs to do for that kind of move to even be plausible, they're skipping the single most important variable in the entire equation. For XRP to have any realistic shot at a historic multi-year run, the most likely path runs directly through a healthy, trending Bitcoin market first. Not because Bitcoin and XRP compete with each other, but because Bitcoin's health is essentially a proxy for overall risk appetite and liquidity conditions across the entire crypto market. If Bitcoin is struggling to reclaim key levels because of macro headwinds like a strong dollar, restrictive Federal Reserve policy, or broader tech sector weakness dragging down risk assets generally, it's very difficult to construct a scenario where XRP simply ignores all of that and rallies independently to multi-thousand-dollar territory. That's not how liquidity-driven markets work. Let's talk about the macro backdrop specifically, because this is where a lot of crypto-focused analysis gets lazy. We're currently in an environment where the Federal Reserve's policy stance has been a meaningful headwind for risk assets broadly. A stronger dollar and a more restrictive monetary policy environment tend to suppress speculative asset performance because capital becomes more expensive and investors have less incentive to chase risk when safer yields are available elsewhere. This isn't a crypto-specific phenomenon. It's the same dynamic that affects growth stocks, emerging market equities, and any asset class that depends heavily on abundant, cheap liquidity to fuel speculative rallies. Crypto, and XRP within it, is not immune to this. If anything, because of its retail-heavy participation base and its position on the more speculative end of the risk spectrum, it tends to be more sensitive to these macro shifts, not less. Now, I want to be fair and present the other side of this too, because a balanced analysis means acknowledging where the macro picture could actually turn favorable. If we do see the Federal Reserve pivot toward a more accommodative stance later this year or into next year, whether through rate cuts or signals of easing financial conditions, that tends to be exactly the kind of environment where risk assets, including crypto and altcoins specifically, have historically performed best. Liquidity expansion is rocket fuel for speculative markets. It was true during prior cycles, and there's no obvious structural reason it wouldn't be true again. So part of the XRP bull case isn't really an XRP-specific bet at all. It's a broader bet on global liquidity conditions improving, on the Fed eventually easing, and on risk appetite returning to markets generally. If you're bullish on XRP for the long term, you're implicitly also making a macro bet whether you realize it or not, and I think it's important to say that out loud rather than pretending XRP exists in some kind of fundamentals only bubble immune to interest rate decisions made in Washington. Let's also talk about something that doesn't get nearly enough attention in most XRP content, which is the altcoin cycle dynamic specifically, separate from Bitcoin's price action. Historically, altcoins have tended to experience their most explosive moves not at the same time as Bitcoin's rally, but in a delayed wave that happens after Bitcoin has already had a strong run and investors start rotating profits into higher risk, higher potential return assets further down the market cap ladder. This is sometimes referred to as alt season, and it's a recognizable, recurring pattern across multiple market cycles, even though the exact timing and intensity vary every time. The honest, evidence-based question for XRP holders right now isn't just, will Bitcoin go up? It's, are we currently positioned in the part of the cycle where capital is starting that rotation into alts, or are we still firmly in a Bitcoin-dominant, risk-averse phase where altcoins continue to underperform and bleed market share? Based on the price action we've discussed throughout this analysis, with XRP underperforming Bitcoin on a relative basis for a meaningful stretch this year, the evidence currently points toward us still being in that earlier, more defensive phase rather than the explosive rotation phase that altcoin bulls are hoping is just around the corner. I also think it's worth addressing smart money behavior directly, because this is a phrase that gets thrown around constantly in crypto content without much substance behind it. What does smart money actually appear to be doing right now, based on observable on-chain and market data rather than vibes? Earlier in this analysis, we talked about meaningful amounts of XRP moving off exchanges into self-custody or cold storage, alongside whale wallet addresses hitting record levels. That kind of behavior, large holders moving supply off of exchanges where it could be sold quickly, tends to be interpreted by experienced market participants as accumulation behavior, since it reduces immediately available sell-side liquidity and suggests holders are positioning for a longer time horizon rather than preparing to trade actively. That's a genuinely bullish data point, and it's the kind of evidence-based signal I'd put far more weight on than a price target derived from a market cap multiplier model. But I want to be careful here too, because accumulation by large holders during a period of price weakness is also exactly what you'd expect to see during a prolonged bear phase, as patient, well-capitalized buyers take advantage of lower prices from less patient sellers. The same on-chain behavior can be read as either smart money is quietly loading up before the next leg up, or smart money knows this asset is going lower in the near term, but believes the multi-year story is still intact, so they're using weakness to build a position slowly. Both interpretations are consistent with the same data. I lean toward the first reading being more likely given the broader infrastructure developments we've discussed, but I want you to understand that's an interpretation, not a fact, and you should hold it with appropriate humility. Let's bring this together as we head into the final part of this breakdown. As fact, crypto broadly and XRP specifically have faced real macro headwinds this year, including Fed policy, dollar strength, and spillover weakness from other risk sectors like semiconductors and broader tech. As fact, XRP has underperformed Bitcoin on a relative basis during this stretch, consistent with typical higher beta altcoin behavior in a risk-off environment. As my own opinion, I believe the path to any historic XRP valuation runs through a healthy Bitcoin market and improving macro liquidity conditions first, meaning XRP bulls are implicitly making a macro bet whether they acknowledge it or not. And I believe we're still in an earlier, more defensive phase of this cycle rather than the explosive altcoin rotation phase that would be required to drive the kind of move people are dreaming about. Let's bring this all together, because I think the most valuable thing I can do in this final section isn't to give you one more price target to get excited about. It's to give you a framework for thinking about this asset that you can actually use, regardless of what happens over the next few months. Let's start by revisiting that headline number that probably brought a lot of you to this video in the first place. $5,000 conservatively, $9,000 on the optimistic end, over a roughly 5-year horizon. We've now walked through what that would actually require. It requires a market structure bill not just passing, but passing in a strong enough form to fully cement XRP's regulatory status. It requires that legislative win translating into a genuine, sustained wave of large-scale institutional capital, not just the retail-driven ETF flows we've seen so far, but pension funds, sovereign allocators, and major asset managers treating XRP as a core holding. It requires Ripple's underlying use case, particularly around cross-border settlement and tokenized real-world assets, to capture a meaningful and growing share of global transaction volume against competition from stablecoins and upgraded traditional banking rails. And underneath all of that, it requires a broadly healthy macro environment with improving liquidity conditions and a Bitcoin market strong enough to pull the rest of the altcoin space along with it into a genuine alt-season rotation. Is each of those things possible individually? Yes, genuinely yes. None of them require something fantastical or disconnected from where things currently stand. But here's the thing about probability that I think gets lost in crypto content built around exciting headline numbers. When you need 4 or 5 separate, individually plausible things to all go right, roughly in the same direction, within a specific time window, the combined probability of all of them landing together is meaningfully lower than the probability of any single one happening on its own. That's not pessimism. That's just how compound probability works, and it's the exact same reasoning that should make you skeptical anytime someone hands you a single number representing an outcome that actually depends on a long chain of underlying assumptions. So what's my honest, balanced take on realistic outcomes? I want to separate this by time horizon because I think that's far more useful than a single number for 5 years out. In the near term, over the next several months, I think the most likely scenario continues to be range-bound, choppy price action, heavily influenced by headlines around the legislative process and by broader Bitcoin and macro-driven sentiment swings. Sharp moves up on positive regulatory headlines, partial retracements when those headlines fail to translate into immediate concrete action, and continued sensitivity to whatever the Federal Reserve and broader risk asset environment are doing. I wouldn't be surprised to see XRP test both meaningfully higher and meaningfully lower levels than where it sits today within this window, simply because that's been the dominant pattern for most of this year already. Over the medium term, the next 1 to 2 years, I think the single biggest swing factor by far is what actually happens with that market structure legislation, and just as importantly, how cleanly and quickly the implementing rules around it get built out afterward. If that bill passes in a meaningful form, and if the rulemaking process moves at a reasonable pace rather than dragging out, I think there's a genuinely credible case for XRP to reclaim and meaningfully exceed its prior all-time highs, which sit in the mid-$3 range from the middle of last year. That's not the $5,000 headline number, but it would represent a substantial, life-changing move in percentage terms for anyone who accumulated during this current period of weakness. If the bill stalls, gets diluted into something with less teeth, or slips well past this year into a more uncertain future legislative window, I think the more realistic outcome is continued range-bound behavior with periodic speculative spikes that fail to hold, similar to the pattern we've already seen play out multiple times this year, over the longer term 3 to 5 years and beyond. I think this is genuinely the territory where wider outcomes become more plausible, simply because more time allows for more of those individually plausible catalysts to actually compound together. This is also, frankly, where I have the least confidence in any specific number, including the ones from that report that probably brought you here. 5 years is an enormous amount of time in an industry that moves as fast as crypto does. Entirely new competing technologies could emerge. Stablecoins could capture a larger share of the cross-border settlement use case than XRP currently anticipates. Or conversely, Ripple's infrastructure could become genuinely entrenched as core financial plumbing in ways that are hard to displace once adopted at scale, the same way certain legacy financial infrastructure has remained sticky for decades once institutions build around it. I think a multi-dollar, possibly double-digit dollar outcome over this horizon is plausible if enough of these catalysts land favorably. I think a $5,000 outcome would require nearly everything to break in the most optimistic direction simultaneously, which is possible but should be treated as a tail scenario rather than a base case you're building your financial plans around. Now let's talk about the psychological trap, because I think this matters more than any specific price target I could give you. The single most common mistake I see retail investors make in this market isn't being wrong about the long-term direction. Plenty of people who held through XRP's legal uncertainty over the years have ultimately been proven directionally correct about the asset's resilience and eventual regulatory progress. The mistake is letting an exciting long-term number distort short-term decision-making. People see a $9,000 target, mentally anchor to it, and then make sizing decisions, leverage decisions, or emotional decisions in the present based on an outcome that, even in the most bullish realistic scenario, likely sits years away and is far from guaranteed. They overextend on margin, chasing a near-term move toward a long-term number. They panic sell during the inevitable 40 or 50% drawdowns that happen along the way in every multi-year crypto cycle because they weren't psychologically or financially prepared for the volatility required to actually capture a long-term outcome. Or they ignore clear deterioration in the actual catalysts we've discussed today, things like the legislative timeline slipping or institutional flows weakening, because they're emotionally committed to a number rather than to the evidence. The investors who actually do well in this market over a full cycle aren't the ones who found the single most exciting price target on the internet. They're the ones who understood the actual mechanics well enough to size their positions appropriately for genuine uncertainty, who stayed engaged enough to update their view as new evidence came in rather than holding a fixed narrative regardless of what the data showed, and who were honest with themselves about the difference between a tail scenario worth being aware of and a base case worth planning your finances around. So here's my final honest synthesis. As fact, XRP has real demonstrated utility in cross-border payments, has achieved a meaningful regulatory milestone through its commodity classification, has functioning regulated ETF products with resilient inflows, and has continued to build institutional-grade infrastructure through Ripple's ongoing development work. As fact, XRP also remains significantly down from its own recent highs, remains dependent on legislation that has not yet passed, remains more exposed to retail-driven rather than large-scale institutional capital so far, and remains highly sensitive to Bitcoin and broader macro conditions that are currently working against the bullish case rather than for it. As my own opinion, formed from weighing all of that evidence together, I believe XRP has a credible, evidence-supported path toward exceeding its prior all-time highs if the regulatory and macro stars align over the next 1 to 2 years, and I believe the more extreme 5-figure outcomes discussed in reports like the one that probably brought you to this video remain genuinely possible over a longer multi-year horizon, but should be understood as the upper tail of a wide range of outcomes rather than the expected or most likely result. The most useful thing you can do with information like this isn't to get more excited or more discouraged. It's to get more precise about what you actually believe, why you believe it, and what specific evidence would change your mind in either direction. That's what separates an investor from a spectator in this market. And it's the only edge that actually persists across multiple cycles, long after any single price prediction report has been forgotten. This content is for educational and entertainment purposes only and should not be considered financial advice. Always do your own research before making any investment decisions. Cryptocurrency markets are highly volatile, and all investments involve risk.